Hi, everybody. Thanks for tuning in. It's Lance Browning with Income Solutions Wealth Management and also Chandler Wealth Solutions. Happy summer and welcome to our 2017 halftime report. And it has been a happy summer and happy 2017 so far for the markets. Let's talk about what we could see moving forward. Meet Bob. So Bob's gone to his doctor and he's had some tests run. And come to find out, Bob's got some medical risk factors going on. He's about 100 pounds overweight. I think he's probably been over-supersizing it at Mickey D's a little bit too much. He's diabetic. He has high cholesterol. He smokes 3 packs a day, and his blood pressure, 200 over 150. We could say that Bob has some medical risk factors that could cause him some trouble, maybe sooner than he thinks. One of the things we are constantly doing is looking at risk factors for the economy and the markets. Markets get into trouble historically when people buy stocks at very high valuations or prices. They buy those expensive stocks with borrowed money, and they do all this while the Fed is raising interest rates or removing stimulus. A PE ratio basically describes how many dollars in price I have to pay for the stock market in order to get $1 of profits or earnings from the companies in the stock market. Normally, you would pay $16 to $17 in price for every dollar of profits the companies in the market earn. We are currently a little north of $30. That's almost double the norm, according to Dr. Robert Shiller. And by the way, Dr. Shiller won a Nobel Prize for economics. Fairly smart guy. In fact, going back into the 1880s, we are currently at the second highest reading ever for Shiller's PE ratio, price to earnings ratio. The tech bubble in the late 90s, early 2000s, of course, was the highest. We are now pretty much at the same spot we were in back before the crash in October of 1929. Now, Shiller's critics will say that he is overstating his PE ratios. Basically, that he's saying the market is more overvalued than it actually is. Here are 4 other market valuation metrics. If you average the 4, and that's shown there in yellow in that box in the upper left, they're saying that the market is about 94% above its normal valuation. Going back to 1900, that would be the second highest reading ever. Pretty expensive. The legendary investor Warren Buffett has indicators that he uses, of course, and Buffett, smart guy too, roughly generally first to the third richest man in the world. Basically, Buffett likes to compare the size of the stock market to the size of the entire U.S. economy. As time has gone on, these two numbers are normally about the same. Now, however, Buffett's indicator shows a stock market that is over 33% larger than the entire U.S. economy. Let that soak in for just a second. That would be the second highest reading since 1950. Hope this makes the point. Even the most bullish of investors will tell you that the market is very highly valued and really pretty expensive. The bulls just believe that it will get more highly valued and more expensive, and they may very well be right. The data shows pretty clearly that people are buying stocks, though, at very high prices. Let's talk about borrowed money. Debt is getting very high as well, both household debt and investor debt. And of course, many of you have seen this chart before, probably numerous times. This goes back a little over 20 years. The blue line is the stock market. The red line is borrowed money in the stock market. You can see the tech bubble here in early 2000. You can see the housing bubble in late 2007. Also notice that both the market and borrowed money in the market are much higher now than they were in the two previous significant market drops. Please remember that borrowed money has to be paid back, unless you're the government, I guess. When you borrow money to buy real estate and you don't pay it back, the lender takes your property away from you and sells it to repay your loan. That's called a foreclosure. The same thing happens in the stock market. It's called a margin call. A margin call basically requires forced selling of stocks to repay loans. Like foreclosures, margin calls are not good things. So we have investors buying very expensive stocks with record amounts of borrowed money. Here's the biggie though. Okay, so we've talked about market valuations. We talked about debt. But that's not really what's driving everything, in my opinion. The big question, the proverbial 800-pound gorilla in the room, is the Fed. What is the Fed going to do? Does the Fed have a plan? To quote the great philosopher Mike Tyson, everybody's got a plan till they get hit in the mouth. Let's see what kind of plan the Fed has. The Fed, in my opinion, is rightfully concerned about the growth rate of the U.S. economy, and we'll talk more about that in just a second. Regardless of their concerns, they are still raising interest rates, and they plan to keep raising interest rates. The Fed also plans on, quote-unquote, unwinding their balance sheet, and I'll take out my Fed speak decoder ring for you, and I'll translate that to English. They're saying they're going to take back a lot of the money that they've printed out of thin air over the last several years. So let's not be a negative Nelly for a second. Let's talk about what could go right. Corporate earnings, corporate profits could grow the right way without accounting tricks like share buybacks. This actually looks like it's starting to happen. In my opinion, the vast majority of earnings, quote-unquote, growth from about 2010 to 2015 was from share buybacks. Companies weren't making any more money. They were simply dividing their same profits by a lot fewer shares of stock. Again, this looks to be changing for the better. The economy could grow beyond the 1% to 2% stagflation range we've been in for the last decade plus. Obviously, this would be a very good thing for the markets and for America as a whole. Lastly, what could go right is for the administration, the Trump administration, Congress, and the Fed to actually coordinate monetary and fiscal policy. And you're probably chuckling as you read this, and I'm having a hard time saying it with a straight face, to be honest, but it could happen. I certainly wouldn't hold my breath, but maybe, just maybe, the dysfunction in Washington can stop long enough to do the right thing. If these three things happen, in my opinion, the markets could very well keep going higher. And that's certainly what the bulls continue to believe. But let's talk about what could go wrong. The biggie, in my mind, again, is the Fed. Janet Yellen is the chair of the Federal Reserve, the U.S. Federal Reserve. So Janet Yellen, or her successor, because she's almost at the end of her term, could cause a hard landing for the economy by removing stimulus, unwinding their balance sheet, raising interest rates, etc. You see, to be a bull, you have to believe that Janet Yellen could pull off what none of her predecessors were ever able to do. Not Paul Volcker, not Alan Greenspan, and not Ben Bernanke. Whenever these gentlemen shifted policy gears from stimulus to destimulus, it caused a shock to the U.S. economy and the stock market. Can Janet Yellen thread the proverbial needle on this? Corporate earnings, profits, could stay the same or actually decline without share buybacks, causing their price earnings PE ratios to go back down to normal. The economy could continue stumbling along at 1% to 2% per year, like it has for the last 10 years. This could cause people, investors, to rethink the valuations of the stock market. Washington, D.C. could continue with its dysfunctional business as usual, disconnected from Fed monetary policy. And lastly, and this is the hard one to predict, a black swan event, geopolitics, a global economic shock, terrorism, 9/11, etc. Always the possibility of something just coming out of the woodwork, some wild card. So here's a snapshot of GDP. That stands for Gross Domestic Product. That's the bottom line report card on the U.S. economy. And this goes over the last 10 years or so. We would like to grow at about 3% a year or more. That's ideal. And you can see that hasn't happened in quite a while. Here's a look at corporate earnings, corporate profits. In theory, at least, these earnings should drive stock prices. 2013 and 2014 were especially fueled by share buybacks, basically an accounting trick. Again, in theory, it will be hard for stock prices to continue to go up unless corporate profits go up. Here's some thoughts from Steve Blumenthal of CMG Capital on corporate earnings and share buybacks. And I think he's absolutely right on. He's taking some notes from a speech by Dr. Lacey Hunt. Dr. Hunt believes that the leveraging of the corporate balance sheet, again borrowing money, has been basically to support the stock market and not for long-term business purposes. Corporations are borrowing money to buy their own stock. You get that? They are engaged in financial engineering by issuing debt, bonds, and buying back their shares of stock, shares of other stocks, increasing their dividends. But it does not increase the growth potential of the U.S. economy. The Fed is largely responsible for this. When they undertook QE, quantitative easing, money printing, it was designed to give the stock market a boost, and it did. But the idea was to create a wealth effect that would then trigger spending and faster economic growth. The notion of a wealth effect is no more than a hypothetical theory, according to Dr. Hunt. If this occurred, we would not see the severe deterioration in secular growth in GDP that's been taking place. The net result is that the Fed signaled to corporate managers that their financial interests were protected by the Fed. The Fed has encouraged the maluse of our debt, and the numbers since 2015 pretty clearly show this. From 2015 to 2016, corporate debt rose by $717 billion. However, investments in plant, equipment, inventories fell by $21.2 billion. You get that? No benefit to the standard of living. None really whatsoever. And here's a look at what Brian Reynolds said in his recent notes, and we'll kind of paraphrase this, but record amounts of money are pouring into the credit market. That's the bond market. Those credit flows are allowing companies to buy back record amounts of stock. That's those share buybacks. Equity prices are only at a marginally new high, and that's a result, even though equity stock investors have been somewhat bearish. Equity stock investors continue to seem to have a hard time grasping this credit-led bull market, even though the mechanics of it are really pretty simple. Our nation's public pensions are bringing in more tax money than ever. They are allocating that tax money, those flows, to aggressive bond funds like high-yield junk bonds. Those funds are buying record amounts of corporate bonds, which gives corporate CEOs the cash with which to buy back record amounts of their stock. Brian's been pounding the table on this for many years now. And these are two very bright and capable people with basically identical visions of what this stock rally has been about. We'll see. As always, we're on the job. Please don't hesitate to call if we can help you or if you have any questions. God bless, and have a great rest of 2017.